Welcome to the Deep Dive. Today we're looking at RPM International's fiscal Q2 2026 earnings call from January 8th. And this one is, it's a really fascinating story. It's just a masterclass in market contradiction. You have this massive headline miss on profits, but then the stock, it just staged this incredible intraday rally, completely defied what you'd expect.
It really did. I mean, if you just looked at the numbers that came out at the open, you would have thought RPM was in some serious trouble. But the story that management told on the call was, it was so compelling, so focused on structural improvement that it just completely rewrote the narrative for investors in real time.
So our mission today is to figure out what exactly was said that made the market decide to focus on that future self-help instead of the present disappointment.
Okay, let's unpack this. It's a company dealing with real external turbulence, but they managed to pivot so effectively that they turned a potential crisis into a rallying point. So what were the initial facts? What hit the tape and set off all the alarm bells? All right, so we have to start with the raw results, because they really did shock the street at first. RPM actually hit record net sales for the quarter, $1.91 billion. That's up 3.5% year over year.
Okay, so that's a positive, but I think the street was looking for $1.93 billion, right? So a small miss on the top line.
A small miss, exactly. The real issue, the real pain point was profitability. If you look at the standard accounting, the GAAP earnings per share, it came in at $1.26. Consensus was for $1.41. So that's a noticeable gap right there.
And for you, the listener who's trying to get to the true operational health of the company, that's where the adjusted EPS figure really comes into play, where they strip out the one-time noise.
Exactly. And that number, the adjusted EPS, was $1.20. You compare that to the $1.41 consensus, and you've got a huge 21-cent miss. That's almost a 15% shortfall.
A 15% miss.
Yeah. And to make it worse, adjusted EBIT, so earnings before interest and taxes, which is your core measure of operational earnings, it actually fell. It was down 6.2% from last year.
Okay, so record sales, but a 15% earnings miss. That divergence just screams for an explanation. How are you selling more than ever, but making less profit? That's where we get into the macro headwinds management talked about.
Management basically laid out three main culprits for that margin pressure. First was just slowing momentum. The quarter started out solid in September, but then they saw this pronounced softness in DIY demand. But the more worrying signal was a definite slowing trend in construction lead times, especially from late October right through November.
And that's important because a construction slowdown isn't just about people putting off a kitchen remodel. It hits their industrial businesses too.
Absolutely. Which leads right into the second factor they called out, political friction. They were very explicit. They cited the impact of a prolonged government shutdown on construction sectors that are tied to federal funding.
Right. So you're saying government funding delays, that uncertainty, it just amplified the project slowdown, all those federally funded projects, roads, public buildings, they just weren't converting from a bid into actual work. And that kind of uncertainty is just toxic for sentiment.
It is. And that uncertainty hit the top line a little bit, but it really crushed the bottom line because the third issue, internal costs. They admitted to temporary inefficiencies and costs from their ongoing operational optimizations.
Oh, okay. This is that classic dilemma. They're doing the right thing for the long term, consolidating plants and warehouses. But what does that mean for right now?
It means higher conversion costs. It means increased freight logistics, temporary duplicate costs while they move inventory. Think of it like remodeling your kitchen. It's going to look amazing when it's done, but while you're living through the construction dust, everything is just inefficient and more expensive. That internal dust was a huge margin headwind.
Okay, so you've got a perfect storm. External macro softness, political gridlock delaying projects, and these internal temporary costs. That explains the huge earnings miss. So this is where the conversation turns on a dime. Management couldn't just offer excuses. They had to give a path forward. What was the big countermove?
The countermove was this massive acceleration of their self-help story. They announced right on the call that they were pulling forward parts of their MAP 3.0 program, specifically targeting deep structural reductions in SG&A.
Okay, let's pause on SG&A for a second. For listeners who don't live and breathe P&L statements, SG&A is. It's basically the overhead, right? Non-production costs, sales teams, marketing, corporate functions.
Exactly. It's the fat you can trim without directly hurting your ability to actually make stuff.
Yeah.
And the goal they laid out is huge. $100 million in annual SG&A benefits once it's fully implemented.
$100 million annual cut. That's a massive number. But the critical detail for investors wasn't just the total. It was the cadence. When does that cash actually hit the bottom line?
And that timeline was the magic bullet for the stock price. They promised 5 million realized in the current quarter, Q3, then an incremental 20 million in Q4. And the rest, the huge chunk, $75 million, is expected to hit in fiscal year 2027.
And that's the hook. The market saw a 21-cent earnings miss now, but immediately pivoted to pricing in the certainty of $75 million in structural savings coming in FY27.
Right.
When you put that $75 million in context of RPM's annual net income, it's a major material boost to future EPS. It's a floor they can control.
And they added certainty by breaking it down. They said roughly 70% is personnel related, 30% is discretionary spending cuts. It makes the savings feel sticky, reliable.
But that raises a question. A $100 million cut sounds great, but personnel cuts, there's always a risk there. Did they address the fear of cutting muscle instead of just fat? You know, if you gut your sales or R&D teams, you could jeopardize future growth.
They did. They really emphasized it was about strategic reallocation, streamlining management layers, getting rid of redundancy after all those consolidations, not gutting innovation. In fact, they doubled down on targeted investments, arguing they're just strengthening the highest return parts of the business.
Okay, so let's look at those investments. Because growth didn't just stop while they were cutting costs.
That's crucial. They're still investing heavily in specific high-performance areas. They talked about business intelligence, basically leveraging the data and marketing know-how they got from the Pink Stuff acquisition and applying that across their whole portfolio. And on the innovation side, they pointed to advanced products like their AlphaGuard Puma waterproofing tech.
Innovation in waterproofing materials doesn't exactly sound sexy, but it's high-margin, specialized work.
Precisely. The AlphaGuard Puma, for example, lets contractors install waterproofing in super cold temperatures. It actually extends the construction season. That takes you out of the commodity game and puts you into specified, high-value solutions.
And speaking of specialized solutions, we have to talk about M&A, specifically that new acquisition for their construction products group.
Yes, the agreement to acquire Kalzip for 150 million euros. Kalzip is a German market leader in metal roofing and facades. And this acquisition is critical because it strengthens their engineered systems offerings.
What does engineered systems mean in practice, like in plain English?
It means they're moving further away from just selling a can of paint and more towards selling these sticky, proprietary building envelope solutions. When a contractor specifies a Kalzip system, that customer is basically locked in for the long term. It adds resilience, high margins. It's a key move to de-risk the business.
Okay. Before we get to the outlook, let's go back to Pink Stuff for a second, because there was a really key non-GAAP accounting detail there that tells us a lot about the DIY market.
Oh yeah, this was a fascinating nuance. They reported a non-cash gain from reversing a $12.7 million earnout liability tied to the acquisition.
Explain earnout liability for us.
So when RPM bought the parent company of the Pink Stuff, they paid a base price. Then they promised the sellers an extra payment. That's the earnout. If the business hit certain, hyper-aggressive sales targets.
And the reversal means what?
By reversing that liability, they're essentially saying, look, the Pink Stuff is doing well. It's hitting our base case. But the broader DIY market is just too soft right now for those initial outrageous growth forecasts to be met. It's an expectation reset. It's not a failure. It's them managing expectations.
That context is everything. So we've got a company facing margin pressure, countering with acquisitions and massive cost cuts. So what does this all mean for the immediate future? What was the guidance?
The guidance was built on, I'd say, cautious optimism. It relies heavily on those SG&A savings starting to flow through and easier year-over-year comps in their consumer group. For Q3, they're forecasting sales to be up mid-single digits. Adjusted EBIT, though, is projected to grow mid to high single digits.
That EBIT grade is the key. It shows profitability snapping back pretty quickly.
Absolutely.
Yeah.
For Q4, sales again expected up mid-single digits.
Yeah.
But the adjusted EBIT range was much wider.
Yeah.
Low to high single digits growth. And management said volume growth is the key variable there, the big unknown.
And that wide range for Q4, it perfectly illustrates this volatility conundrum they're facing. The company is on a roller coaster, and they actually gave the data to prove it, which is pretty rare.
It's incredible whiplash. The quarter starts solid in September. Then you get that disappointing slowdown in November that caused the miss.
Yeah.
But then they reported a shocking December sales figure. Sales surged 12.1%. Unit volume was up 7%.
Wow, a 12.1% jump in December. Imagine being the CFO watching those numbers month to month. That extreme swing explains why they can't narrow their Q4 guidance. They just don't know if that December spike was a real market rebound or just a catch-up of all that deferred business from Q2.
So is the recovery here to stay? Or was December a fluke? That's the big question. And the market's intraday rally basically answered that question for them. The stock opened down over 4%, but by the afternoon, it was trading up 3%. Investors just explicitly chose to focus on what RPM can control.
It's a powerful statement. They're placing a much higher value, a higher certainty, on that $100 million structural plan than they are on the near-term noise from the macro environment. Investors are buying the future certainty of a leaner, more profitable company.
They bought the structural floor created by those SG&A cuts. That's the whole story.
You know, it's interesting. By giving that monthly data, by being so transparent about the chaos, management actually might have enhanced their credibility. They didn't hide the swings. They basically said, look, this is the chaos we're dealing with, and here's our plan to make money no matter which way the wind blows.
Right. And that honesty really resonated. It's micro catalysts over macro drama. And now, as is tradition for our deep dive, we move to our "this is not financial advice" trade idea. A purely conceptual analysis, of course.
We're looking for an outrageous but plausible thesis that leverages this tension between the structural cuts and the external chaos.
Okay, so the core thesis is this. The current market price implies a discount for all that macro uncertainty we just talked about, that extreme monthly volatility. But the $100 million cost savings, especially that $75 million coming in FY27, are structural and they're highly certain. The outrageous but plausible bet is that the market is currently underpricing the near certainty of that future cost structure improvement.
So we want to go long on the structural improvement, which we think is a sure thing, while hedging or even profiting from the near-term macro volatility. So how do you actually execute a bet like that?
I think the best mechanism for this specific bet would be using calendar call spreads. Think about it this way. The market is assigning a really high premium to options that expire in the near term, in Q3 or Q4 of this year, because of all that uncertainty.
Right. High premium means they're expensive to buy, but valuable to sell.
Exactly. So you sell those short-term calls to monetize the market's current fear and volatility. Then you take the money you make from selling those, and you use it to purchase long-dated calls. Maybe ones that expire after that critical FY27 earnings release.
So you're selling the risk you don't want, the unpredictable short-term volatility, and using that cash to finance a bet on the long-term, highly certain catalysts you do believe in. The $75 million in savings, that's clever. It effectively separates your investment from the short-term chaos. So what does this all mean for you, the listener? RPM presented this really complex picture. You had record sales, but a major profitability miss. The market, though, it pivoted. It chose to focus on the company's decisive plan for internal optimization, which promises that highly certain $100 million in annual savings.
Yeah, investors just looked right past the disappointing Q2 figures. They saw management offering a controllable, structural $75 million boot to the bottom line coming in FY27. It's a classic case of rewarding internal resilience over all the macro noise.
I think the most provocative thought for you to carry forward is this. RPM management showed this incredible willingness to tear down its own internal structure in the face of macro pressure. Does that signal genuine long-term confidence in their products? Or have they just given the street a really effective distraction from a fundamentally chaotic environment?
And that tension certainty versus chaos, that's what's going to define their stock performance until FY27.
Thank you for joining us for this deep dive. We hope this gave you the shortcut you needed to be well informed on RPM International's Q2.